On the night of November 27th, 2025, at exactly 10 o'clock Eastern Standard Time, Amir Siazwan sat at his trading desk in Kuala Lumpur, watching his screens go black. For the first time in his 8-year career at Ninefold Trading Company, the Chicago Mercantile Exchange, the machine that processes $26.3 million in daily derivatives volume and controls 90% of global precious metals price discovery, simply stopped. No bids, no offers, no prices, just silence. The official explanation came within minutes. Cooling system failure at the Cyrus 1 data center in Aurora, Illinois. A chiller plant malfunction. Engineering teams deploying temporary equipment. Markets halted across currencies, treasuries, equity indices, and commodities. Just a technical issue, they said. Nothing to see here. But Siazwan knew something the press release didn't mention. Since October 9th, COMEX registered silver inventory, the actual metal available for futures delivery, had hemorrhaged 70 million ounces in 6 weeks. Shanghai silver stockpiles had collapsed to decade lows. London vaults were running on fumes, and silver was breaking higher into the thinnest liquidity window of the entire year. Thanksgiving weekend, when Wall Street sleeps and trading volumes vanish. The timing wasn't random. Silver was up 84% year to date, testing $54 per ounce, threatening to shatter the 45-year-old record of $49.95 set during the 1980 Hunt Brothers squeeze. For 10 hours and 30 minutes, the world's most sophisticated financial infrastructure depended on air conditioning working correctly in Illinois. When it failed, 90% of global derivatives trading froze. No hedging, no arbitrage, no exit. Siazwan spent the entire afternoon on the phone with his broker, unable to close positions, unable to manage risk, watching his exposure grow with every hour the exchange stayed dark. In London, Ritik Kata woke up thinking his internet was out. In New York, month-end rollers were trapped in December contracts they couldn't exit. The paper market had frozen, but the physical market kept moving. When the CME finally reopened at 8:30 on Friday morning, silver didn't retreat. It exploded, surging 5% to $56.86 per ounce, a new all-time nominal record. Bid-ask, spreads that normally measured pennies, ballooned to dollars. And somewhere in that 10-hour gap, everyone realized simultaneously there were 2.4 paper claims for every ounce of deliverable metal in the vault. The system only worked if traders never actually demanded physical delivery. One data center, one cooling system, 10 hours, and the entire illusion that paper and physical are the same thing shattered in the dark. Most Americans were asleep that night. It was Thanksgiving, after all, the one holiday when Wall Street actually shuts down, when trading desks go quiet, when the financial machine takes a breath. But in Kuala Lumpur, it was Friday afternoon, and Amir Siazwan wasn't thinking about turkey or football. He was staring at a screen that had just gone completely dark. No market data, no price quotes, no order flow, nothing. His first thought was simple. His internet had died. He refreshed the page, checked his connection, rebooted his terminal. Still nothing. Then his phone started ringing. His broker in Singapore, his counterparty in London. Everyone asking the same question. What the hell just happened to the CME? The Chicago Mercantile Exchange is not just another trading venue. It is the central nervous system of global derivatives trading. Every day, $26.3 million in contract volume flows through its systems, currency futures, treasury bonds, equity indices, agricultural commodities, energy contracts, and precious metals. When you hear about the price of oil, or the dollar index, or gold futures, you are hearing about prices discovered on CME's electronic platform called Globex. This platform runs from a single data center in Aurora, Illinois, a 450,000 square foot facility that houses the matching engines, the order books, the entire infrastructure that keeps global finance moving. High-frequency trading firms pay millions of dollars annually just to co-locate their servers within feet of the exchange's matching engine, fighting for microsecond advantages in a world where speed is profit. The entire ecosystem, banks hedging currency exposure, pension funds rolling treasury positions, commodity producers locking in prices, speculators betting on direction, all of it funnels through this one point. And on November 27, 2025, at 10 o'clock at night Eastern Standard Time, that point failed. The official story came quickly. A cooling system malfunction. A chiller plant at the Cyrus 1 CHI-1 data center had experienced technical difficulties. Server racks were overheating. Engineers were deploying temporary cooling equipment. Markets would remain halted until the issue was resolved. The statement was brief, technical, almost boring. Just another infrastructure hiccup in the endless complexity of modern finance. Except this wasn't a minor glitch. This was the entire global derivatives market going dark during a breakout in silver prices that threatened to expose the most dangerous secret in commodity trading. The difference between paper contracts and physical metal. To understand what broke that night, you need to understand the machine itself. The COMEX silver futures contract is deceptively simple. 5,000 troy ounces of 0.999 fine silver deliverable in New York. Every trading day, thousands of these contracts change hands. Speculators betting on price direction, producers hedging future output, manufacturers locking in costs. Most participants never intend to take physical delivery. They are trading paper claims on future silver, rolling positions forward month after month, settling differences in cash. The system works beautifully as long as one critical assumption holds, that physical metal will be available when contracts mature and someone actually demands delivery. Here is where the fragility hides. In late November 2025, COMEX vaults held approximately 113 million ounces of registered silver, metal specifically designated as available for delivery against futures contracts. But open interest, the total number of contracts outstanding, represented roughly 244% of that vaulted silver. Think about what that means. For every ounce of deliverable metal sitting in a New York vault, there were 2.44 paper claims circulating in the market. The system operates on fractional reserves, just like banking. It only functions if most traders roll their contracts forward and never demand the underlying metal. The moment a significant portion of contract holders says, "Deliver my silver," the math collapses. This is why price discovery matters so desperately. In a functioning market, buyers and sellers meet continuously. Orders match. Prices emerge from millions of transactions flowing through the exchange every second. When the CME went dark for 10 hours, that process simply stopped. Yet silver kept trading elsewhere in over-the-counter markets in London and Shanghai. Dealers quoted prices without the anchor of futures. Spreads widened from pennies to dollars. Arbitrage opportunities emerged and sat there uncaptured because the main venue for hedging those positions was offline. Fawad Razakzadeh of City Index put it bluntly. Without the CME, spreads on spot prices would typically widen with spot liquidity providers not having much confidence in pricing without the futures. The dangerous truth is this: futures prices typically lead spot prices. When COMEX is functioning, physical dealers use futures markets to hedge their inventory risk. Refiners lock in prices for future production. Miners manage their exposure. The entire physical supply chain depends on the paper market working correctly. When it does not, the machine seizes. And everyone realizes simultaneously that there is no backup system that actually matters. The world's most sophisticated financial infrastructure, the platform controlling 90% of global precious metals derivatives, depends entirely on air conditioning working correctly in a data center in Illinois. The numbers tell a story the official statements never mentioned. Since October 9th, 2025, COMEX registered silver inventory had dropped from approximately 183 million ounces to 113 million ounces by late November. That is 70 million ounces gone in 6 weeks. Not moved to eligible storage, where metal sits, but remains unavailable for delivery. Gone, withdrawn, shipped out of the system entirely. This was not slow attrition from normal market activity. This was a run on the vault. The deficit driving this drain is structural, not cyclical. Silver has been in supply shortage for 5 consecutive years. The Silver Institute reported 2024's shortfall at 282 million ounces, total demand of approximately 1.3 billion ounces against supply of just over 1 billion ounces. The cumulative deficit since 2021 exceeds 800 million ounces. That is nearly 1 full year of global mine production, simply gone. Above-ground inventories have been covering the gap, but they are finite. Every month, the market consumes more silver than it produces, and eventually the stockpiles run dry. What makes this deficit irreversible is the demand side. Unlike gold, which serves primarily monetary and investment functions, silver is over 50% industrial. Record industrial demand in 2024 hit 680.5 million ounces, up 4% year over year, marking the 4th consecutive annual record. Solar panels alone consume massive tonnage, and photovoltaic installations are exploding globally as countries pursue net zero commitments. Electric vehicles need silver in their electrical systems. 5G infrastructure requires silver. Artificial intelligence data centers use silver in servers and components. This is not speculative demand that evaporates when prices rise. This is structural, irreversible demand growth, baked into the global economy's infrastructure build-out. The supply side cannot respond. Here's the trap. 75 to 80% of global silver production comes as a byproduct of copper, zinc, lead, and gold mining. When copper prices are weak, copper mines slow production, and silver supply drops with them, regardless of what silver's price is doing. Primary silver mines represent only 20 to 25% of total output. Higher silver prices cannot fix the shortage if base metal economics do not support expansion. Supply is structurally inelastic. You cannot simply drill more wells or open new mines overnight. Silver projects take 7 to 10 years from discovery to production, and there is no wave of new supply coming. Meanwhile, Shanghai Futures Exchange silver inventories fell to their lowest level since 2015 in November 2025. Over 75 million ounces of silver left COMEX vaults since early October, with significant flows heading to London and then potentially onward to Asia. The metal was not disappearing. It was moving from west to east, from exchange vaults to private hands, from paper markets to physical demand that could not be satisfied with promises. The timing of the CME blackout was not coincidental. When the exchange froze at 10 o'clock on November 27th, silver was in full breakout mode, testing resistance levels that had not been touched in 45 years. Traders holding short positions, betting that silver would fall, could not cover their exposure. Long traders could not take profits. Month-end rollers, investors moving positions from December contracts to future months, were stuck. For 10 hours, risk management simply stopped. In derivatives, markets built on leverage and continuous hedging, that is an eternity. The outage did not happen in isolation. United States bank reserves hit $2.8 trillion in late 2025, their lowest level since 2019. The Federal Reserve's standing repo facility, an emergency liquidity backstop that typically sees 0 to single-digit billions in usage, recorded $24 billion in borrowing at month-end November. For context, on October 31st, that facility saw $50.35 billion in usage, the highest level since 2019. Repo rates spiked above the Fed's target range. Money markets were tight. The financial system was operating with razor-thin liquidity margins. And now the derivatives exchange controlling 90% of global volume was offline during the most illiquid trading window of the year. The real carnage came after markets reopened. In the first 4 trading days of December 2025, 47.6 million ounces of COMEX registered silver were claimed for physical delivery, over 60% of available registered inventory. Open interest for December delivery spiked to 7,330 contracts, representing 36.65 million ounces requesting settlement in a single day. This was not normal roll activity. This was forced delivery into a tight physical market. Someone needed physical metal, badly, and they were willing to stand for delivery rather than roll forward. Market analysts offered comforting narratives to explain away the pressure. Recycling will fill the gap, they said. Reality check. Recycling contributed approximately 150 million ounces in 2024, leaving a 132 million ounce deficit even after scrap flows. New mines will come online, they promised. Reality, there is no wave of new primary silver supply coming, and projects take 7 to 10 years to develop. High prices will destroy demand, they assumed. Reality, industrial demand for solar panels and electronics is price inelastic. Manufacturers do not stop building electric vehicles because silver hit $60 per ounce. The trap was fully visible now. You cannot solve a physical shortage with paper contracts. You cannot deliver silver that does not exist in the vault. You cannot restart price discovery when the exchange is dark. You cannot unwind the largest derivatives position in the world when the matching engine is offline. The paper market was built for financial speculation, not physical delivery at scale. November 27th was the night that assumption died. Paper traders who believed the official story got destroyed. When markets reopened at 8:30 on the morning of November the 28th, silver did not drift back to equilibrium. It gapped violently higher, from around $54 to over $56 in minutes. Stop-loss orders triggered in cascades. Short sellers scrambled to cover positions that had grown exponentially more expensive during the blackout. Anyone betting on mean reversion after a technical glitch learned an expensive lesson. When physical markets are tight, technical glitches accelerate squeezes rather than relieve them. The assumption that normalcy would return was itself the trade that failed. The real losers were those who trusted the system's plumbing. Traders who assumed COMEX could always clear, who believed registered inventory was sufficient, who thought leverage ratios did not matter as long as everyone kept rolling contracts forward. In the week after the outage, backwardation emerged, front-month futures trading below spot prices, a clear signal of immediate physical shortage. By mid-December, silver lease rates, the cost to borrow physical metal for delivery, remained elevated. The paper game was over. The market was demanding metal, not promises. Physical holders won. Anyone who owned actual silver bars in allocated storage, coins in personal possession, warehouse receipts for segregated metal, watched the nominal value of their holdings hit all-time highs. Silver closed November 28th at $56.30 per ounce. By December 5th, $59.32. By December 10th, silver breached $60 for the first time in history. By December 23rd, over $70. Year-end 2025 saw prices approaching $84 per ounce, up nearly 90% year over year, dramatically outpacing gold's 58% gain. Unhedged primary silver miners captured windfall profits. while base metal producers who generated silver as a byproduct remained locked into long-term supply contracts at fixed prices. Pure silver mining companies with unhedged production sold into spot markets at record highs. Companies holding physical inventory, refiners with allocated metal, investors who bought physical during the 2023 to 2024 corrections, all positioned correctly for the squeeze. The structural reality is simple. This is not over. The 5-year cumulative deficit of over 800 million ounces represents a fundamental supply-demand imbalance that cannot resolve quickly. Industrial demand for solar, electronics, and electric vehicles is not cyclical. It is structural and growing. Supply remains constrained by base metal economics and the decade-long lag in mine development. Above-ground stocks are depleting. Every month, the global silver market consumes more than it produces, and the gap is widening. When the cooling failed in Aurora, Illinois, it was not the air conditioning that broke. It was the illusion that paper and physical are the same thing. 10 hours was all it took to prove that derivatives built on fractional reserves cannot withstand actual delivery demand. The squeeze nobody saw was the inevitable result of 5 years of deficit meeting a market structure designed to never be tested.